Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines.
All right, sounds good.
Everyone, today we're going to dive into a mix of market moves, investor strategies, and even some international AI intrigue. Get ready for some surprising insights. You might want to grab a notepad for this one.
Sounds like we have a packed agenda. I'm ready to unpack these headlines. Where should we begin?
Let's start with MarketWatch and this story about billionaire investor David Tepper, who seems to be doubling down on his investments in China.
Oh, okay.
It's interesting because while some investors are getting cold feet about China's economic outlook, Tepper appears to be all in.
That's right, and the details are pretty fascinating. Recent 13F filings, which give us a glimpse into the holdings of large investors, reveal that Tepper's Appaloosa management significantly increased its stakes in companies like Alibaba and JD.com last quarter.
So for those of you who might not be familiar with 13F filings, these are quarterly reports that institutional investment managers with over $100 million in assets under management must file with the SEC. They disclose their holdings of U.S. publicly traded equities. It's important to note that these filings are delayed, but they can offer valuable clues about how these big players are positioning themselves in the market.
Exactly, and in Tepper's case, it seems he's betting big on China, even with all the uncertainty surrounding its economy. MarketWatch highlights concerns about their property sector and ongoing tensions with the U.S. So why is he so bullish? Well, the article suggests that Tepper is drawn to what he sees as incredibly attractive valuations. Specifically, he's pointed to single-digit price-to-earnings ratios combined with the potential for double-digit growth in the future.
Okay, so break that down for us. What does that mean for investors like you and me?
Think of it this way. When a company has a low price-to-earnings ratio, it means its stock price is relatively low compared to its earnings per share. This can be a signal that the market is undervaluing the company. Now, if you combine that with high growth potential, meaning the company is expected to increase its earnings significantly in the coming years, it creates a very appealing scenario for investors. You're essentially buying a company at a discount with the expectation that its value will increase significantly as its earnings grow.
Ah, I see. So Tepper is essentially betting that these Chinese companies are undervalued right now and poised for a major comeback. It's a high-risk, high-reward situation, wouldn't you say?
Absolutely. Investing in China always carries its share of risks, and those shouldn't be ignored. But Tepper clearly believes the potential rewards outweigh those risks. Whether this bold bet will pay off remains to be seen, but it's certainly something to keep an eye on.
Speaking of big investors making moves, Barron's is reporting that everyone's eagerly awaiting Warren Buffett's next move as Berkshire Hathaway's 13F filing is due any minute now. Any thoughts on what it might reveal about his strategy?
Well, just like Tepper's filings, Berkshire Hathaway's 13F is always highly anticipated. It gives us a glimpse into the mind of one of the most successful investors of all time. And this time, there are some specific questions on everyone's mind.
Barron's mentioned that Berkshire has been trimming its Apple holdings significantly in the past year. Could this mean Apple is no longer their top holding? They were also selling off shares of Bank of America, weren't they?
Yes, and those moves have fueled a lot of speculation. Is Buffett simply taking profits? Does this signal a shift in his overall investment philosophy? Or could there be other factors at play? It's a puzzle that analysts and investors are eager to solve.
And to add to the intrigue, Barron's also reported that Berkshire bought Domino's pizza stock. Domino's. Really? Is this a classic Buffett move, or is someone else calling the shots here?
This purchase raises some interesting questions about the role of Todd Combs and Ted Weschler, Berkshire's investment managers. They manage about 10% of the portfolio, and their investment styles might differ from Buffett's. Perhaps this Domino's acquisition is more their style.
That's fascinating. So we have one investor going all in on China, while another seems to be diversifying into pizza.
Yeah.
But let's shift gears and talk about something that might hit closer to home for our listeners: hedge fund fees. This Bloomberg article caught my attention because it claims that some multi-strategy hedge funds are raking in huge gains, but investors are only seeing a small fraction of those profits due to these so-called pass-through fees.
That's right. This article is definitely worth digging into. These pass-through fees are essentially additional expenses beyond the typical 2% management fee and 20% performance fee that hedge funds are known for charging.
Bloomberg gave a pretty shocking example. Dmitry Belazny's fund reportedly had a 15% return. But after all these fees were deducted, investors only saw a 2.8% return.
Wow, yes, that's a significant difference. And it highlights the importance of understanding the fee structure of any investment you're considering, especially when it comes to hedge funds. These pass-through fees can cover a wide range of expenses, from operational costs to more extravagant items.
The article listed some pretty wild examples, like private jet travel and even employee snacks being covered by these fees. Come on, are those really necessary expenses that should be passed on to investors?
Well, hedge funds argue that these fees are essential to attract and retain top talent, invest in cutting-edge technology, and maintain their competitive edge in the market. They claim that these expenses ultimately benefit investors by contributing to higher returns.
I understand that argument, but this Bloomberg article is raising some serious questions about transparency and fairness. If I'm investing my hard-earned money, I want to know exactly where it's going, wouldn't you?
Absolutely. Transparency is crucial in any investment relationship, and this article definitely highlights the need for greater transparency in hedge fund fee structures. Investors need to be fully informed about how their money is being used and what those fees are actually covering.
Okay, let's move on from hedge fund drama to something a little more futuristic.
Yeah.
CNBC is reporting that the EU just announced a massive $200 billion investment in AI. Can they actually catch up to the US and China with this kind of commitment?
The global AI landscape is incredibly dynamic, and this is a major development. The EU's investment, which includes both public and private funding, is specifically aimed at making Europe a leader in what they're calling trustworthy AI.
200 billion. That's a serious chunk of change. But trustworthy AI, what does that even mean? Is it just a fancy marketing term, or is there more to it?
It's more than just a buzzword. Trustworthy AI reflects the EU's focus on developing AI systems that are ethical, transparent, and respect fundamental rights. It's a different approach from the US and China, which are often perceived as prioritizing speed and innovation above all else.
So it sounds like the EU is trying to carve out its own path in the AI race, focusing on responsible development rather than just chasing the latest technological advancements.
Precisely. The EU is trying to address concerns about the potential negative impacts of AI, such as job displacement, privacy violations, and algorithmic bias. They're aiming to build AI systems that are beneficial to society as a whole and that align with their values.
It will be interesting to see how this plays out. Will the EU's emphasis on ethical AI give them a competitive edge? Or will the US and China maintain their dominance with their more aggressive approaches? It's a question with far-reaching implications.
Indeed, the AI race is just heating up, and the next few years will be critical in shaping the future of this technology. It's something we'll definitely be keeping a close eye on.
And speaking of races, let's talk about another one that's making headlines: the race for OpenAI. CNBC is reporting that Elon Musk wants to buy OpenAI, the company behind ChatGPT, but OpenAI's CEO just said, no thank you.
This story has certainly captured a lot of attention. OpenAI, with its groundbreaking language model ChatGPT, is at the forefront of the AI revolution. And Musk, who was one of the co-founders of OpenAI, has expressed concerns about the direction the company has taken since his departure.
And CNBC is reporting that Musk's bid is being viewed with some skepticism. He claims he wants to ensure OpenAI stays true to its original mission, which was to develop AI for the benefit of humanity. But OpenAI CEO Sam Altman seems to think it's just a tactic by Musk to slow down a competitor. Some are even calling Musk a swindler for this. What are your thoughts?
It's a complex situation with a lot of history. Musk has been critical of OpenAI's move away from its nonprofit roots and its close ties to Microsoft. His proposed takeover has raised questions about his motives and the potential consequences of his involvement.
Adding another layer to this drama, Bloomberg is reporting that Tesla's stock price is actually being impacted by all of this. Investors seem to get nervous when Musk appears distracted by other ventures.
That's a valid point. We've seen this before with Musk's other ventures. Remember the acquisition of Twitter? That led to a significant drop in Tesla's share price. Investors worry that Musk's attention is being pulled in too many directions, which could detract from his focus on Tesla.
So should Tesla investors be genuinely worried? Or is this just a temporary blip and we'll see things stabilize soon?
It's difficult to say for sure. Musk is known for his ambitious and often unpredictable moves. Whether this OpenAI bid is a serious attempt at a takeover or just a strategic maneuver remains to be seen. But it's definitely something Tesla investors are keeping a close eye on.
Okay, let's switch gears again. We're going from the world of AI to the arena of trade wars. MarketWatch is reporting that Trump is back at it with tariffs, this time on steel and aluminum imports. Here we go again. What does this mean for global trade and, more importantly, for our wallets?
Tariffs are always a complex issue, and these new tariffs, set at 25% and affecting all countries, are likely to have a ripple effect across various sectors. We could see price increases for consumers and potential retaliation from other countries.
The Wall Street Journal is reporting that the administration views these tariffs as a necessary step to protect American jobs and industries. But a lot of economists are warning about the potential downsides.
Exactly. There are concerns that these tariffs could ultimately hurt the very industries they're intended to protect. They could lead to higher costs for manufacturers, which could then be passed on to consumers in the form of higher prices. And of course, there's the risk of retaliation from other countries, which could escalate into a full-blown trade war.
MarketWatch is also reporting that the markets are already reacting. Gold prices have surged to record highs as investors seek a safe haven. That's usually not a good sign, is it?
Gold is often seen as a safe haven asset during times of economic uncertainty. This surge in gold prices indicates that investors are concerned about the potential consequences of these new tariffs. They're looking for stability and security, and gold is often seen as a way to achieve that.
It's interesting, though, that the bond market seems relatively calm amidst all this tariff drama, at least according to MarketWatch. Does that tell us anything about the outlook for stocks?
The bond market can provide valuable insights into investor sentiment. The fact that bond yields haven't spiked dramatically suggests that investors aren't panicking yet. It could be a sign that they believe the economic impact of these tariffs will be manageable, or it could simply be a case of tariff fatigue setting in.
One expert even told MarketWatch that he's looking forward to a broadly boring year in interest rates. Can we dare to hope?
It's certainly possible, but we have to remember that the economic landscape is constantly evolving. There are always potential risks and opportunities on the horizon. It's important to stay informed, assess the situation carefully, and make informed investment decisions.
Well, I'm not sure boring is what I'd wish for, but I'll take stable any day. Okay, last but not least, let's zoom out to the bigger picture for a moment. This Bloomberg article about the UK selling a record £13 billion bond caught my attention. Apparently demand was through the roof. What's driving this investor frenzy?
This bond sale is a fascinating example of how investors are responding to shifting economic conditions. The UK has been navigating a challenging economic environment with the Bank of England lowering interest rates amidst concerns about fiscal stability.
So with all that uncertainty, why are investors so eager to buy up these UK bonds?
It's all about relative value and the search for yield. With interest rates falling, investors are looking for opportunities to lock in higher returns. UK bonds, even with the perceived risks, are still seen as attractive compared to other options.
It seems like investors are willing to take on more risk to chase those returns, even if it means venturing into potentially volatile territory.
That's a key takeaway from today's deep dive. Whether it's betting on China, navigating hedge fund fees, or riding the waves of the AI race, investors are having to make tough choices in a complex and rapidly changing world. It certainly is a topic that keeps evolving and throwing curveballs our way. Speaking of curveballs, did you catch that article in the Financial Times about a potential shakeup in the luxury goods market?
Oh yeah, the one about LVMH considering a bid for Richemont.
Yeah.
That would be a major power move, wouldn't it?
Absolutely. Richemont owns some of the most iconic luxury brands like Cartier and Van Cleef & Arpels. If LVMH, which already has a massive portfolio with names like Louis Vuitton and Dior, were to acquire Richemont, it would create a true luxury goods behemoth.
The Financial Times suggested that Bernard Arnault, the chairman and CEO of LVMH, is always looking for ways to expand his empire, and this move would certainly solidify their position at the top of the luxury market.
It's a brilliant strategic move if they can pull it off, but it wouldn't come cheap. Richemont's market capitalization is over 70 billion euros, so this would be one of the biggest acquisitions in the luxury goods sector.
The Financial Times also mentioned that this potential deal could face regulatory hurdles, antitrust concerns, and of course, the willingness of Richemont shareholders to sell. It'll be interesting to see how this plays out.
Definitely. This is one of those stories we'll need to follow closely. Speaking of following things closely, how about we dive into this report from Bloomberg about the surge in demand for cybersecurity professionals? Ooh, that's a hot topic these days. With cyber attacks becoming increasingly sophisticated, companies are scrambling to beef up their security measures, and they need skilled professionals to do it.
Exactly. Bloomberg is reporting that there's a massive shortage of cybersecurity talent right now, and it's only expected to get worse in the coming years.
So what kind of impact is this shortage having on companies and organizations?
Well, for starters, it's making it much harder for them to adequately protect themselves from cyber threats. They're struggling to find qualified candidates to fill these critical roles, which leaves them vulnerable to attacks.
Bloomberg mentioned that the average salary for cybersecurity professionals has skyrocketed in recent years as companies compete for top talent. It's a job seeker's market right now if you have the right skills.
Absolutely. And it's not just about technical skills either. Companies are also looking for individuals with strong communication and problem-solving abilities, people who can think critically and adapt to rapidly evolving threats.
So if any of our listeners are looking for a career change with high demand and great earning potential, cybersecurity might be worth exploring.
It's definitely a field with a lot of opportunities. Okay, let's switch gears again. This time, let's talk about something a little closer to home, literally. The Wall Street Journal has an interesting piece about the booming housing market in suburban areas.
Ah, yes, the great suburban migration.
Yeah.
We've been hearing about this trend for a while now, haven't we? With the rise of remote work and a desire for more space, people are fleeing crowded cities and heading for the suburbs.
Precisely. The Wall Street Journal is reporting that demand for homes in suburban areas has surged, driving up prices and creating bidding wars.
So what's fueling this demand? Is it just about remote work, or there are other factors at play?
It's a combination of factors. Remote work is definitely a major driver as it's given people more flexibility in terms of where they live. But there's also a desire for more space and affordability that's driving people to the suburbs.
The Wall Street Journal mentioned that families with young children are particularly attracted to the suburbs for the larger homes and better schools.
That's right. And let's not forget about the amenities that many suburban areas offer. Parks, trails, and community centers. All of these factors are contributing to the surge in demand.
But this increased demand is also creating challenges. The Wall Street Journal highlighted concerns about housing affordability and the strain on infrastructure in some suburban areas.
That's an important point. As more people move to the suburbs, the demand for housing outpaces supply, which drives up prices and makes it more difficult for first-time buyers to enter the market. And the influx of new residents can also put a strain on existing infrastructure like roads, schools, and utilities.
It's a complex issue with no easy solutions.
Yeah.
But it's definitely something to keep in mind if you're considering a move to the suburbs.
Agreed. Okay, let's switch gears one last time. I want to talk about this thought-provoking article I came across in The Economist. It's about the growing debate over the role of central banks in the fight against climate change.
Well, that's an interesting one. Central banks traditionally focus on monetary policy and controlling inflation, but now they're being asked to consider the impact of climate change as well.
Exactly. The Economist argues that central banks are uniquely positioned to play a role in addressing climate change because of their influence over financial markets and their ability to promote sustainable investments.
But there is also a lot of debate about whether central banks should be involved in this issue at all. Some argue that it's not their mandate and that it could distract them from their core responsibilities.
That's a valid concern. But the counterargument is that climate change poses significant risks to financial stability and that central banks can't afford to ignore it.
The Economist highlighted several ways central banks could contribute to the fight against climate change, such as incorporating climate risks into their stress tests and promoting green bonds.
They could also use their regulatory power to encourage banks to lend more to sustainable projects and to divest from fossil fuel companies.
It's a complex issue with a lot of different perspectives. But it's clear that the role of central banks is evolving and that climate change is going to be a key consideration in their decision-making going forward.
I think that's a great point to wrap up this segment on. It's been a whirlwind tour of the financial news landscape today, from mergers and acquisitions to cybersecurity concerns to the impact of climate change.
It certainly has.
Yeah.
And we've only just scratched the surface. There's always more to explore and analyze.
But for now, let's take a quick break, and we'll be back with more insights and analysis.
All right, we're back and ready to continue our deep dive into today's financial headlines. With all this talk about economic uncertainty and market volatility, it's easy to get caught up in the short-term fluctuations.
Right.
But I always find it helpful to zoom out and consider the long-term trends as well.
That's a great point. It's easy to get lost in the day-to-day noise of the markets. But understanding the bigger picture, the long-term forces that are shaping the global economy, is essential for making informed investment decisions.
Speaking of long-term trends, I was reading this fascinating article in The Atlantic about the rise of impact investing.
Oh, yeah. Impact investing. It's been gaining a lot of momentum in recent years. It's all about investing in companies and projects that are not only financially viable, but also generate positive social or environmental impact.
Exactly. The Atlantic highlighted the growing demand for impact investing from both individual and institutional investors. People are increasingly looking to align their investments with their values.
And it's not just a feel-good trend anymore. Impact investing has become a serious force in the financial world, with trillions of dollars flowing into impact-oriented funds and companies.
The Atlantic article mentioned that millennials and Gen Z investors are particularly drawn to impact investing.
Yeah,
They're more socially conscious and want their investments to make a difference in the world.
that's a key demographic shift that's driving this trend. And it's not just about individual investors either. Institutions like pension funds and endowments are also incorporating impact considerations into their investment strategies.
So what are some of the areas that impact investors are focusing on?
The Atlantic mentioned a wide range of sectors, including renewable energy, sustainable agriculture, healthcare, education, and affordable housing. These are all areas where investors can have a positive impact while also generating financial returns.
It's exciting to see that more and more investors are recognizing that they don't have to choose between doing good and doing well.
Yeah,
They can do both.
absolutely. Impact investing is a win-win proposition. It allows investors to support companies and projects that are making a positive difference in the world while also potentially earning competitive financial returns.
So if any of our listeners are looking for a way to align their investments with their values, impact investing is definitely worth exploring.
Agreed. Okay, we've covered a lot of ground today, from market moves to investor strategies to long-term trends. What are your final thoughts?
I think the key takeaway from today's deep dive is that the financial world is constantly evolving. We're seeing new trends emerge, new technologies disrupt traditional industries, and new challenges arise for investors.
That's a great point. It's an exciting time to be following the markets, but it's also more important than ever to stay informed and be adaptable.
Absolutely. We need to be willing to challenge our assumptions, embrace new ideas, and constantly seek out new information.
And most importantly, we need to remember that investing is not just about maximizing returns, it's about making informed decisions that align with our goals and values.
Well said. I think that's a great note to end on. Thanks for joining me on this deep dive into the financial news. It's been a pleasure, as always.
The pleasure was all mine.
We'll see you all tomorrow morning with new headlines from major financials magazines.